The mortgage broker sat across from the young couple, sliding the paperwork forward with a reassuring smile. "Don't worry about the fine print," he said. "Housing prices only go up." It was 2006, and within 2 years, that couple would lose everything. Their home, their savings, their future, all evaporated in the financial crisis that nearly broke the global economy. Today, as we stand in 2026, the signs surrounding us are eerily familiar. But this time, the powder keg is vastly bigger, the fuses are shorter, and the systems designed to contain the blast have been weakened beyond recognition. What's coming isn't just another recession. It's a fundamental restructuring of the economic order that will make 2008 look like a dress rehearsal. Let's start with the numbers that should terrify anyone paying attention. In 2008, the total global debt stood at approximately $177 trillion. Today, that figure has exploded to over $315 trillion, nearly doubling in less than 2 decades. But here's where it gets truly frightening. This isn't just government debt or corporate debt. Household debt in developed nations has reached unprecedented levels, with the average American carrying over $104,000 in total debt, including mortgages, credit cards, student loans, and auto loans. The system didn't learn from 2008. Instead, it doubled down on the very mechanisms that caused the crisis in the first place, flooding the world with cheap money and creating asset bubbles in virtually every market simultaneously. The real estate market provides the clearest warning sign. In 2008, the crisis was largely contained to residential mortgages in the United States. Today, commercial real estate is collapsing globally, while residential prices remain artificially inflated in major cities around the world. Office buildings sit empty as remote work has permanently altered the landscape. Yet these properties are valued on balance sheets as if it's still 2019. Regional banks across America are sitting on hundreds of billions in unrealized losses from commercial real estate loans that will never be repaid at the values they were written. Unlike 2008, when the crisis originated primarily in the housing sector, today we're facing simultaneous crises across multiple asset classes: real estate, bonds, stocks, and cryptocurrencies, all inflated by over a decade of near-zero interest rates and unprecedented money printing. The financial instruments that nearly destroyed the economy in 2008 haven't disappeared. They've multiplied and evolved. Derivatives, those complex financial weapons of mass destruction, as Warren Buffett called them, now total over $600 trillion in notional value. That's roughly 7 times the entire global economy. These aren't just abstract numbers on a spreadsheet. Each one represents a bet, a leverage point, a potential domino that could trigger cascading failures throughout the system. The collapse of Silicon Valley Bank and several other regional banks in 2023 provided a glimpse of how quickly confidence can evaporate. But the Federal Reserve's aggressive intervention merely postponed the reckoning rather than preventing it. What makes 2026 uniquely dangerous is the collision of multiple crisis vectors simultaneously. The geopolitical situation has deteriorated dramatically since 2008. We're witnessing the fracturing of the globalized economic order that has existed since World War II. Supply chains that were optimized for efficiency rather than resilience are breaking down. The assumption that goods would flow freely across borders in pursuit of profit is being challenged by a new era of economic nationalism and strategic competition. China, which helped pull the world out of the 2008 crisis through massive stimulus spending, is now facing its own real estate crisis that dwarfs America's subprime mortgage disaster. Evergrande and other property developers have defaulted on hundreds of billions in debt, and the contagion is spreading through the Chinese financial system like a virus through an immunocompromised patient. Energy markets add another layer of instability that didn't exist to the same degree in 2008. The transition away from fossil fuels is happening simultaneously with underinvestment in traditional energy infrastructure, creating a volatile situation where energy prices can spike dramatically with little warning. Europe's energy crisis, following the disruption of Russian gas supplies, demonstrated how quickly modern economies can be brought to their knees when energy security is compromised. Unlike 2008, when oil prices collapsed during the crisis, the next downturn could see energy prices remain elevated or even increase due to supply constraints, creating a nightmarish scenario of stagflation, economic stagnation combined with persistent inflation. The tools that central banks used to fight the 2008 crisis have been exhausted and are no longer available. Interest rates were slashed to zero, and trillions in quantitative easing flooded the markets with liquidity. When the next crisis hits, rates are already elevated after the rapid tightening cycle of 2022 and 2023, and central banks have far less room to maneuver. Their balance sheets are already bloated with assets purchased during previous interventions. The Federal Reserve, European Central Bank, and Bank of Japan have all discovered that extracting themselves from extraordinary monetary policy is nearly impossible without triggering the very crisis they sought to prevent. They're trapped, and the markets know it. Social and political instability represents another dimension that will amplify any economic crisis in ways that 2008 didn't experience. Trust in institutions has collapsed across the developed world. Faith in government, media, corporations, and financial institutions has eroded steadily. When the next crisis hits, the social cohesion necessary to implement and accept painful reforms will be largely absent. We're already seeing populist movements on both the left and right gaining strength by promising radical solutions to economic anxiety. The political polarization that has intensified since 2008 means that coordinated policy responses will be far more difficult to achieve. Instead of pulling together, societies are more likely to fracture under economic stress, leading to policy paralysis or extreme measures that could worsen the situation. The wealth inequality that has exploded since 2008 means that the next crisis will hit the majority of people far harder than the last one. The recovery from 2008 was heavily skewed toward asset owners, those who owned stocks, real estate, and businesses. Workers saw stagnant wages while asset prices soared, creating the widest wealth gap in modern history. When assets deflate in the coming crisis, millions who believed they were financially secure will discover their wealth was illusory. Retirement accounts that appeared adequate will prove insufficient. Home equity that seemed solid will evaporate. The social contract that promised stability in exchange for hard work and prudent saving has already been broken, and the next crisis will shatter whatever remains. Technology creates both opportunities and vulnerabilities that didn't exist in 2008. High-frequency trading algorithms now dominate financial markets, capable of triggering flash crashes and amplifying volatility in ways that human traders never could. Cryptocurrency markets represent an entirely new category of risk, with trillions in value that exists largely outside traditional regulatory frameworks. When crypto markets collapse, not if, but when, the contagion will spread into traditional finance through the numerous bridges and connections that have been built between these worlds. Meanwhile, artificial intelligence is beginning to disrupt labor markets in ways that will accelerate during an economic downturn, with companies using crisis conditions as cover to replace human workers with automation at unprecedented scale. The banking system itself is fundamentally more fragile than it appears. Despite claims of reform after 2008, the largest banks are bigger than ever, creating even more severe too-big-to-fail problems. The capital requirements and stress tests that regulators tout as proof of stability are based on models and assumptions that consistently underestimate tail risks. Shadow banking, the network of non-bank financial institutions like hedge funds, private equity, and money market funds, has grown dramatically and operates with far less oversight than traditional banks. When liquidity dries up in a crisis, these institutions will face runs just like traditional banks, but without the same safety nets. What regulators and policymakers call the Great Reset isn't a conspiracy. It's an inevitability. The current system is mathematically unsustainable. Debts that can never be repaid will eventually be defaulted on, written down, or inflated away. Assets with valuations disconnected from underlying fundamentals will correct violently. The question isn't whether this will happen, but when and how chaotic the process will be. Some envision a managed transition to new monetary systems, potentially involving central bank digital currencies that give governments unprecedented control over economic activity. Others see a more chaotic collapse and rebuilding. Either way, the economic landscape on the other side will look radically different from what we know today. The parallels to 2008 should serve as warnings, but the differences should terrify us. We're not facing a crisis in one sector of one country's economy. We're facing multiple interconnected crises: financial, geopolitical, environmental, social, and technological, all converging simultaneously with depleted policy tools and fractured societies. The life raft that pulled us through 2008 has holes in it, the crew is fighting amongst itself, and the storm on the horizon is far larger than the last one. Those who recognize what's coming have time to prepare, to reduce debt, to build resilience, and to protect what they can. Those who remain confident that the system will muddle through one more time are making the same mistake as that couple sitting across from the mortgage broker 20 years ago. The difference is that this time, when the crisis hits, there won't be another decade of can kicking left in the system. The reset is coming whether we're ready for it or not. Claude is AI and can make mistakes. Please double-check responses.